Well, office property prices in Europe's largest financial hub, London, could drop by as much as 20% within 3 years of a so-called Brexit. According to some estimates, shares of UK property developers have tumbled to 31-year lows. Meanwhile, residential real estate is also expected to take a hit. Joining us to talk about all of this is Hemant Kotak. He's Managing Director and Real Estate Analyst at Green Street Advisors, and he does join us from London. Hemant, thank you very much for joining us. If we see large financial institutions, and certainly we've had JP Morgan Chase musing about this publicly, moving jobs out of the UK because of the Brexit vote, what will that mean to? Let's start with the office real estate prices. What will that do to the office segment of London real estate?
Well, I think that's clearly negative for office demand. What we're expecting to see is a number of banks, just like JP Morgan, thinking about what their weighting is to London for their European operations, and clearly this would hurt demand. So we would expect to see a fall off in the number of jobs in London and moving out to other areas, possibly Paris, Frankfurt and Dublin are other areas.
We've seen several real estate funds suspend redemptions recently. That's because more investors are coming to them saying that those investors want their money out of the fund than they're able to handle. What's that telling us about real estate sentiment in London right now? Is that a short-term phenomenon, or is that part of the beginning of a longer-term trend on real estate pricing in London?
You know, I think this is probably, it feels short-term in the nature. These funds, these open-ended funds, are structurally flawed in the sense that they have underlying property which is very illiquid by its very nature, with daily redemptions from retail investors, say. So there's very much a liquidity mismatch here, and I think it's very appropriate that these funds have gated and halted the redemptions, therefore allowing themselves some time to do orderly sales. So, you know, we're not seeing fire sales and therefore prices depressed. So I think it's a short-term phenomenon. I think they've bought themselves some time. One of the positive things is that going into 2016, fundamentals were actually pretty healthy.
So I guess two questions. First is what's the probability that Britain doesn't actually exercise Brexit, that the new Prime Minister doesn't trigger the Article 50 and start the process or start the timer? And secondly, how many jobs are in the financial sector in the UK that could truly be affected? So if the UK doesn't get the EU passport regulation that's needed to trade Eurobonds and Eurobond activity, how many jobs are we looking at here?
Well, by our estimates, we have 75,000 jobs. So roughly speaking, this is made up of the biggest hit to the financial sector, where we think ultimately as much as 15% of the jobs in London's financial tenant base could actually be moved away to the locations that I mentioned earlier. And then there's, of course, the business and professional firms that support the financial sector, and I think there could be a small impact there. So there is a pretty material impact. If you scale that in terms of the office-based employment, it's about 4%. So a little bit worse than what we saw in the global financial crisis, which was roughly 2 to 3%.
What would the knock-on effect be to the residential real estate market? We often hear about sky-high valuations in the London residential real estate market. Is there any potential for residential real estate to cool off?
You know, I think it's already been cooling for the last 6 to 12 months for exactly the reasons that you've highlighted. The prices were runaway, they were sky high. And one thing or another, there needed to be a pause. And I think what the referendum result is bringing is an excuse for investors to say, actually, do I really want to buy prices when they're all-time high? Just to frame it, prices are about 50% higher at the beginning of the year versus the peak that we saw in 2007. So a pretty material increase compared to the rest of the UK, where prices were actually roughly in line, maybe even down in some cases in the regions.
Thank you
So
very much.
I think they do have a fair bit to fall.
Go ahead, finish your thought.
No, I was just going to say, I think they do have a fair bit to fall. The indications, the early indications are that buyers are trying to chip off anywhere between 5 and 10%, and that could be as much as 20%. And then, of course, if you're an international buyer where sterling has actually fallen 15%, then you add those two things together and you're getting a pretty decent discount.
Hemant Kotak, Managing Director and Real Estate Analyst at Green Street Advisors, spoke to us in London, and we thank him for doing so.